Can you guys still hear me?
Yes.
Okay.
In here, you cannot see you, Bruce.
Yeah.
You look better this way.
Thank you.
Okay, here's Frank, get them out. Frank. Okay, we're here to get started. Excellent. Well, good. Good morning, everyone. I believe we have everyone here. Yes, everyone looks like they're here. So let's get started. Thank you, all of you, for taking the time to join us. For those of you who may not know me, my name is Chris German with The Apartment Dealer. I specialize in the sale of multifamily investment properties here in Southern California. Over the past 2 decades, I've had the opportunity to work with hundreds of apartment owners like you as they navigate the strategic decisions that come with owning this asset class. And if there's one thing most landlords would agree on right now is this: the apartment business today does not feel the same as it did a few years ago. Values have shifted in many markets. Operating costs have climbed. Tenant protections continue to expand. Evictions have become more complex and more litigious. And at the same time, we're watching broader forces at play. Things like interest rates, capital markets, and even macroeconomic questions around employment and technology, all of which ultimately impact the stability of rental housing. So the goal of today's discussion is not to create fear. It's not even to predict the future with perfect certainty. The goal is preparation, because the investors who tend to do well through different market cycles are the ones who stay informed, surround themselves with knowledgeable professionals, and take the time to think strategically about their portfolio. That's exactly why I host my apartment owners educational luncheon every year. For the past 17 years, I've brought together professionals from different parts of the real estate ecosystem, legal, lending, taxation, and market analysis, to help apartment owners better understand the landscape they're operating in. Today's webinar is an opportunity to give you a taste of those conversations and to introduce you to the caliber of professionals we bring together. We have a tremendous panel lined up for you today with us. So first up joining us is Mr. Mike Brennan, an eviction attorney who has spent decades representing landlords and serving on legislative committees where many of the housing laws affecting our industry are first discussed. We also have Mr. Steven Spear, a real estate attorney, investor, and radio host who helps owners understand how to structure and protect their assets in an increasingly regulated environment. Gil Figueroa is with us as well. Gil works closely with apartment investors on financing and refinancing their assets, so he has a front row seat to what lenders are actually looking for in today's market. We're joined by Greg Burns, who specializes in 1031 exchanges and helps investors understand how to reposition capital without unnecessarily triggering taxes. Alongside him is John Taylor, who works extensively with Delaware statutory trusts and other structures that allow owners to move from active property management into more passive investments. And we're also fortunate enough to have with us, at least an audio version, where we can't quite get Bruce's video to work, but Bruce Norris, who has been analyzing real estate cycles for decades. And many investors look to his research and insights to better understand where we may be headed in the coming years. So what we're going to do today is have a conversation. We're going to talk about what each of these professionals is seeing from their vantage point, legally, financially, and economically, and what apartment owners should at least be thinking about as they plan for the next phase of the market. And my hope is that by the end of this conversation, you walk away with a clearer perspective on the risks, the opportunities, and the strategic decisions that may lie ahead for your portfolio. So with that, let's begin. Gentlemen, thank you for being with us. And I know that you have a heart for investors. That's who we work with day in and day out. And so we're going to field some questions here that were introduced by those taking a part of this Zoom webinar, as well as those that are going to be attending our upcoming live event here in a few weeks. First question up. And again, we want to roundtable this. If no one jumps in right away, I may pick on one or two of you to contribute. But again, let's have a conversation. If someone has owned apartments for 20 to 30 years, what feels fundamentally different about the business today compared to even 5 years ago?
Social media has created an environment where lawyers think that there's a great deal of money to be made by suing derelict landlords. And sometimes there are frivolous lawsuits against good landlords, but usually it's because the landlords haven't done something right or have done something wrong, aren't doing what they're supposed to do in providing proper space for residents. And so I would say that's one of the major changes.
I would
Mike?
add to that Stephen's absolutely right. It is not just social media, though. There are cities that have contributed to that, like the city of Los Angeles, by creating these anti-tenant harassment laws and right to public counsel laws that are working in conjunction to really create a significantly higher rate of litigation, active litigation against landlords.
You know, at our last live event, towards the end of the event, you may remember I asked the whole panel the question, do you think apartment ownership has fundamentally changed from this point forward? In other words, it's not just a blip in the real estate cycle, but fundamentally owning apartments has changed. And, you know, I alluded to the fact that years ago, an apartment investor could have purchased a multifamily building, half managed, half been involved, just kind of hang on. They wake up 20, 30 years later, a self-made millionaire. And that worked for many, many investors, clients that I know. They admittedly would say, yeah, I kind of just got lucky. And my argument would be to take that position today going forward will lead to complete failure. What say you?
It,
Maybe Gil? Gil, what do you think?
Oh, 100%. I mean, just take into account that interest rates have doubled in the last 5 years. We have insurance that's gone up at least 20 or 30%. We have all the rental laws that are against the landlord. So absolutely, if they didn't prepare for this, there's no way they can continue. It's just too much of a deficit. So I think the future belongs to somebody who has a game plan and can execute a game plan and allow themselves to have somewhat of a large cushion for any other issues they may rise. And if they're not ready or prepared, maybe they need to have that conversation of switching assets or selling.
I would say that your example, Chris, of the half manager, half in, half out, that's gone. Management has to be done with full capability, full attention, complying with all the rules, not just in letter, but in spirit, to do the job of a landlord and do it right.
I think being in the 1031 exchange business, we're always looking at improving an investor's portfolio through an exchange in some way. And so part of that is understanding what they own today. And to your point, Chris, I think for that investor who's woken up a self-made millionaire 20 years later, they've seen their equity significantly improve. The cash flow distributions on that equity have not kept up with the appreciation of the asset itself. And so some of those investors who are now 20 years older than they were are looking for cash flow now more than ever before and seeing some headwinds on the ability to extract consistent monthly cash flow from their apartment buildings.
And Greg, you're in the 1031 exchange business. What's most common you hear from landlords of why two things. One, why they're actually expanding, they're increasing the size of their portfolios, and then two, those that are actually exiting. What's most common between the two groups?
I think the ones that are expanding on their portfolios, those typically are individuals who are good operators and go there and aggressively figure out ways to maximize value in that property. The ones that are exiting the space are, kind of like John's talking about. They're doing it for either geographic reasons. We're seeing obviously a lot of people go into passive investments, which is typically common. And we're also seeing kind of an interesting phenomenon going on right now where people are buying kind of untraditional 1031 spaces where they're, maybe buying, properties for their kids, allowing their kids to be their tenants, manage those assets. I would probably say, in the 27 years that I've been doing this, I'm probably seeing more of that than I've ever seen in my career.
Now, Mike, we're hearing from owners who feel like the margin for error is shrinking. What are the legal mistakes today that are getting landlords into trouble that maybe wouldn't have mattered so much, say 5 or 10 years ago?
Failing to respond instantaneously to legitimate resident requests that are related to habitability, or failing to respond effectively to those requests. So you can't come in with a screwdriver and fix things with chewing gum and baling wire. You have to fix them right. You have to fix them right away. And you have to deliver service. The best way for a landlord to think of it is the residents are my customers, not my subordinates, not my guests, not people who are somehow not entitled to what they're entitled to. Live up to the responsibilities of a landlord. Courts look to and promote good faith behavior according to reasonable standards. And when a plaintiff's lawyer is looking for someone to sue, they love it when they can show discourteous conduct by a lawyer, ignoring the resident, coming in and making ineffective repairs, making unreasonable demands, dictating policy to residents that's not consistent with good apartment management.
Well, I think Stephen's right about that. I was going to say it's a two-pronged situation right now. He just touched on one of them, which is the civil litigation aspect. It's a growing industry among attorneys. And so there is no room for, there's no margin for error in that aspect either. He's right. You cannot be that guy you referred to, Chris, that, or that woman that, you know, buys a property, wakes up in 20 years, kind of halfway with your arms around it and succeed at this. That's going to get you sued. But the other aspect of it is, you know, from my perspective, the evictions, there is no margin for error. There's, you know, they are every single year they expand the affirmative defenses that a tenant can raise, and any non-compliance whatsoever, whether it's a state law, a local ordinance, a rent control, or a just cause ordinance, any non-compliance is going to render your case entirely ineffective. And I'll give you an example. It could be something that happened 20 years ago. You could have changed ownership 20 years. You owned it. You transferred it into a trust 20 years ago, and it only gets brought up now in an eviction that you never served what we would call a 1962 letter, for example. You never served the letter notifying people of the change of ownership. And here you are 20 years later, and your eviction is sunk because you didn't do that 20 years ago. So with the growing army of attorneys, it used to be pretty easy. You had fewer jurisdictions that had rent control or just cause. You had significantly fewer attorneys on the tenant's side. And now that's all changed. Virtually every jurisdiction in Los Angeles area specifically, and the surrounding areas, has some sort of a rent control. Even the state has a just cause ordinance before you can evict. And there's just this growing army of attorneys that are starting to approach evictions, and they have been for the last couple of years. They're approaching evictions like traditional civil litigation, depositions, full rounds of discovery. They're pulling your title. They're going to the city and pulling all the complaints that have been lodged against the property. And so you've got this two-prong approach now where you can sink your eviction, but on top of that, what Stephen was saying is, you know, it's also turning you into a target for proactive litigation against you as a landlord. So it's really kind of a dangerous situation being a landlord, unless you have all of your ducks in a row and you are a good operator and you've got all of this stuff planned out in advance, which, you know, my experience is most of my clients aren't that great, aren't that proactive. And as the laws change all the time, just staying on top of what they need to do is its own challenge. So it's a whole different world now.
And yet this should not discourage anyone from owning and managing real estate. It would be like saying driving a car is extremely dangerous. You can hurt people, you could hurt yourself, it could be a disaster. But if you're sober and you're paying attention and you're not eating your sandwich or running your text device, and you're looking out the window and you have proper rubber on your tires and good brakes on your car, you're probably going to do just fine, and it's worth the risk. So if you can drive a car and learn how to do that and do it consistently, safely, you learn how to do this. This doesn't require mountaintop knowledge. This is something where there are a few simple rules.
Now, Steve, you know, we're hearing more and more about habitability claims, lawsuits, insurance issues. How should owners be thinking about protecting their assets and structuring ownership in this environment?
No one should own a rental property in their own name. No one should own a rental property in their family trust. All rental properties should be owned inside of protected entities, entities that limit liability. Typically, that would be an LLC, a limited liability company. They're not terribly expensive to form. They're easy to control, easy to manage, easy to run. And what they do is they act like watertight doors on a ship, so that what happens in the LLC stays in the LLC. It doesn't come out and endanger other assets that you own that are not in an LLC. So with proper insurance and a proper limited liability company, properly formed and properly maintained, you can manage your risk to a place where it's just as tolerable as when you drive your car and you have risk. But if you have proper insurance and you behave properly, you're probably not going to lose your house.
Hey, Stephen, I'd like to ask you a question on that because I have a slightly different opinion about it. One of the biggest challenges my clients are facing, and I'm sure we have crossover clients, but one of the biggest challenges they're facing is insurance and the inability to obtain proper insurance. I have clients that are calling me saying, hey, my insurance company is about to drop me. I've got mortgages that require me to have insurance. So this is a big area of this industry that is outside of their control. And so what are you seeing as far as that's concerned? As you say, it's the same risk as driving a car. And that's where I slightly disagree. I've got clients who have gotten sued and they come to me with the lawsuit and I say, I don't do this kind of stuff. Turn it into your insurance company. And their first response is, I don't want to turn it into my insurance company because I have multiple buildings with them and they're going to drop me on all of them. And my mortgage requires the insurance. So how are you navigating your clients through those situations?
So first, when you have a strategic decision to make as to whether you submit a claim to insurance or not, that requires analysis. You could consult with your real estate attorney. You could consult with your insurance broker, your insurance advisors. There are ways to make that decision. So you make it the same as you would if you had a minor fender bender and you decided not to send that to insurance. So there's that first. Second, the insurance problem in California was generated by the government of California when they said insurance is too expensive, so we're going to put a cap on it. Can't charge more than this. And that's a good idea, they thought. Of course, the insurance companies responded, starting with State Farm and right on down the road, by saying, okay, well, we're not going to sell insurance here anymore. So then you have a tremendous shortage. The governor has figured out that that's a problem took a couple of years, but he's figured it out. And so now they're trying to encourage insurance companies to come back in by making more friendly rules. They haven't been able to cross the bridge yet, but that'll straighten out and it'll become easy because insurance companies want to sell insurance. They need to be able to make money doing it. The third thing is to become politically active in helping the California legislature decide that it would be a better idea not to provide free attorneys to tenants, not to provide rules that make it so it's just a wealth redistribution system like workers' compensation or unemployment insurance, where when someone applies, they just get the money. And then it's going to be a question of the insurance companies themselves making decisions to fight rather than settle to discourage frivolous lawsuits. This is what was done by insurance companies in the 1990s. During the 1970s and 80s, anybody who said, I slipped, tripped, or fell could collect $2,500 to $25,000 without even filing a lawsuit because the insurance companies said it was cheaper to settle than to fight. Since they've changed that policy, if it's frivolous, they'll fight it. They won't put any money on the table. And the result now is you cannot find a contingency lawyer to take a case for slip, trip, and fall where the damages aren't serious and real. It's very rare now to see a frivolous slip, trip, and fall lawsuit because the lawyers know it won't pay. And there are some people who would say, gee, that deprives the public of the right of redress of grievances, and it's nonsense. It is a question of whether it's a legitimate claim or not. Legitimate claims, you have no trouble finding a lawyer, bringing a lawsuit, and recovering. Illegitimate claims, you have a lot of trouble. That's what needs to happen in the real estate field.
Now, transitioning here to finance, Gil, a lot of owners built their portfolios during low interest rate years. What's changed in underwriting and lending that owners need to understand at this point?
Well, Chris, if we're talking about 5 years back, I mean, obviously interest rates have doubled, number one. Number two, the fact that some lenders are increasing their debt service from the norm, which was at that time 115 to 120. Now we're at 125 debt service. They're also using a hurdle rate. And some of the bigger lenders like Chase are adding in reserves, and they're asking for 9 months reserves of the total portfolio owned by the owner, the principal. That's a lot of money in reserves. I've also run up a situation with Chase where on a refinance, they used the actual loan amount as the calculator for property taxes. And I've never seen that before. So instead of seeing the actual property taxes, they're using the loan amount and increasing that on their underwriting and hence decreasing the loan amount. So I think that's a way for them to lower cash out refis, higher cash out refis, a way for them to not really get in that space. So we're seeing that a lot. On the same token, we are seeing some lenders that are filling that void as far as being able to get a little more aggressive. And those are from the DCSR programs that we're seeing for 5 to maybe 12 units. And those programs are more aggressive. They're allowing us to lend about 15% more than your standard bank, but the rates are higher by at least 2%, 1.5 to 2%. But overall, I mean, lenders are looking at net worth. They're looking at clean credit. They want a clean credit story. They will pass on transactions quite quickly if there's really any blemishes. So right now, you have to be a very strong operator to get good pricing and good financing.
Gil, if you have someone who comes to you, they own a property, the loan is coming due, and they have to refinance, what problems are you seeing and how are you able to help people?
Well, the main problem you're seeing is if the property won't debt service because it was debt servicing at 3.5 versus trying to debt service at 5.75 or 6. So we're seeing debt service issues. So to mitigate that, what we're doing in essence, sometimes we have to be aggressive and even offer a bridge loan for them to cover until they do either renovations, rent increases, or maybe sell. So there is a bridge product. Other than that, we're looking at their total portfolio. We look at our clients at a 20,000 foot level and say, hey, you have equity in these positions that if we pull equity out, we can lower that loan amount that's coming due, and we can basically be able to debt service that asset. So we really have to be particular of what the objectives are, what we have to work with, and make the hard decisions now. If this is just a situation where you're going to have to pay down the loan and you can't, maybe it's time to sell or get into another product.
Thanks, Gil.
Thank you.
So, recently I recorded a video. I have my staff put up the YouTube QR code here. You guys go to my YouTube channel. But I was answering the question many landlords were asking, hey, Chris, we're several years down the road. I raised rents. How's my building worth less? And it's a function of, multiple things happening in the market. So for you, Gil, again, with the refinance question, let's say if investors have not stayed on top of their rental increases, obviously now most folks who took advantage of the 2-3% rate, during, that early 2020 era, they're having to make decisions about refinancing. For those folks who didn't stay on top of their rental increases, they have a bleeding heart for the tenants. Well, Chris, after all, you can't raise the rents on the folks. Look at the economy, XYZ. What are you seeing with their prospects of getting a loan today?
Well, that's the majority of our transactions. So some of them do have the equity position where they're still debt servicing. Some don't.
Even though because values have slipped the last 3 years, right? So year after year, we've come down. Depending on where people own, it's 15 to 20%. And again, so for those folks, would you say, again, I'm looking at, because I'm trying to raise people's awareness of the importance of rental increases here. Value slipped. They didn't stay on top of their rental increases. The interest rate doubled. How hot do you look for a refinance?
Well, again, if they don't debt service based on current rents, you have to have another plan to mitigate, either a bridge loan to cover, or maybe just sell or refinance another product to pay down this particular product. Now, one thing we've been using effectively is interest-only loans. So the interest only loan is going to really drop that payment, and that's going to help on, you know, the big change, so to speak, on that payment shock. So interest only really helps. But again, the metrics are the metrics. If the property doesn't debt service, they either have to bridge, stay on adjustable programs, which we're not seeing lenders call the loan due, even though they're non-performing technically. So they're non-performing. Stay on the adjustable program, or if there's a balloon, obviously they got to make a decision. But there's 3 or 4 options. But what I'm seeing is a lot of people are pretending this is going to go away and we're going to get a 4% rate to save them. And I think that is a horrible, horrible way of thinking. And you have to have a real strategic game plan based on mathematics, just simple math, and see if they can overcome this. And if they can't, they need to have a game plan.
Yeah, much of what I'll discuss at our upcoming live event is why interest rates alone are not going to save the market. And that's a great segue to Bruce. Bruce, we can now see you now. I'm happy to see your
That was
handsome
my
face there.
my error, not your person's error.
Okay, excellent. So Bruce, that's a great segue for you. So you and I spent a whole day together. I was at an all-day conference that you held here recently in Ontario. The title was essentially "What Comes Next Has Never Happened Before," and I know that, you know, for the live event you'll dig more into the intricacies of this, but many owners are asking whether this is just a temporary slowdown, a blip on the radar, or if something bigger is happening in the real estate cycle. What say you?
I don't think the real estate cycle was the problem. I think what's going to happen to employment could very well be. So at the event, the last chapter wasn't written until 2 days before the live event. So that's why I didn't make the document, because I really had to consider all these things. So it's interesting, I haven't heard any mention of artificial intelligence impacting people's ability to pay rent, that type of thing. So I'm curious where everybody stands on that. I'm not talking about a year from now. I'm talking about when it gains momentum and takes over a lot of jobs. So we have history of a couple of things. We have a Japanese economy that went to zero for 25 or 30 years. And we have a time period for America when we had, what was the event where everybody had to stay home for
COVID.
9
COVID.
months? COVID, thank you. And so we know what happened to interest rates. And so I look at that, I'm looking at that going, okay, if that event happens, there's really bright people that are not talking about 15% unemployment. They're talking about a lot higher unemployment than that. So, you know, that was the problem, is I'm sitting here going and looking at this going, okay, we haven't really had unemployment get to a very high number and then not have a solution for it to go back down to another number right away. So I do think interest rates, again, whenever you put something in writing, I don't think it's next that interest rates are going to be super low, but I think in the next 3 years, they could very well be. And this is from a guy that wrote on a document 3 years before it happened, 40 trillion in debt, 2% mortgage rates, and everybody was, Bruce, you're out of your mind. And then I was online with John Burns, who has a report that all the builders buy, and I was texting him as the 10-year T-bill went below 1%. So yeah, events can happen. And I think, you know, that's the thing about rentals, you know, the stability of your renter probably has a lot to do with their employment. So I'd have to give that some thought, who your renter is. By the way, who my renter is. I have them too.
Well, so, you know, I was in the room, several of us were in the room in 2019 when you posed the question, what if we had a black swan event and then COVID happened? And you couldn't have guessed, but you were asking the question, like, have you essentially stress tested your portfolio? I was in the room at your event when you said, look, we're either going to 1% interest rates or a decade of lost values. We're now into year 4 of a decade of lost values. So you definitely have a knack of seeing what's coming. And so what you're proposing with AI, I don't think any of us would disagree. Those of us who use it in our, I mean, I sat at a conference, a real estate conference, where for 3 days they basically were saying, here's how you fire all your staff and make more gross income. And there's all these apps and there's all, AI and so on and so forth. That's happening across obviously many industries. So you're saying, hey, to your tenant base, consider, can AI snuff them out? And if and when it does, who replaces them? What's the supply and demand? What then happens to rental rates? Based upon what then happens to rental rates, what does your ability to service debt look like? And then it's just a cascade effect.
Well, also consider how many people will probably not be able to buy a property. So if you have a lot of unemployment, you're not going to get a yes answer from the lender, which means they're going to be a renter. So I think that's really interesting also to look at the percentage of transactions that will occur by buyers, new buyers might be diminished a lot. So it's like I said, it's always interesting when you contemplate something that has never happened. And then you have to look for pieces and go, okay, what did happen over here? And it happened over here this way, and try to draw a conclusion. It's no fun to put something in writing years before it occurs, by the way.
Bruce, the employment bone has always been connected to the apartment bone. And so what I've heard many people say for many years is that you could have a drop off in the need for industrial property, office property, retail property, but that the need for people to put their head down on a pillow every night is never going to disappear, because you can't sleep on the internet, and you can't have someone who works in the building, a janitor or a barber or a doctor. They can't go to China. They have to live somewhere near where they work. Has that changed? Is there something that you think will counter the supply and demand of the current shortage of 4 million housing units across the country, that will drive the values down? How does that connect up with the employment issue?
I don't know that the values are going to go down. I think your renter is going to become unemployed many more times. So, okay, what do you do with that? So he's probably going to end up being on some kind of income, but far less than what he has. You guys take the application. What are these guys, like wealth in the bank? What kind of cushion do they have? Do they have a year's supply of money or a month? I would say it's not a year very often. So I would say that when unemployment comes, it's kind of funny. Maybe you ought to rent to plumbers and electricians, because that will be harder to replace than somebody that's in the tech world.
Well,
And I never even heard of AI until 4 months ago, honest to God. And all of a sudden I went, holy cow, this is a very big deal.
I'd like to jump in on this, because I know Chris has known for years. I've been saying this. Hey, this is what's coming. This is why the cities and the states are implementing just cause ordinances. This is why the laws are changing now, where you cannot evict people for overcrowding in an apartment, unauthorized occupants. This is why the laws are changing. In 2020, Section 8 was determined to be a source of income, and you cannot say no to Section 8 anymore. This is why the laws are changing even in the past couple of years, where anybody who receives any sort of a subsidy, you cannot use their credit report anymore as a determining factor whether you're going to rent to them. You have to allow them to give you, and it's their option. You have to allow them to give you an alternative source of ability to pay, such as Section 8, VASH programs, any federal subsidy. So the government has recognized has recognized AI for at least, I would say, 10 to 15 years now, that it's going to result in a housing problem. And they've been slowly changing all these laws designed to keep these people not only in the unit, to force the landlords to accept the people, to keep the people in the unit, and to allow them to bring other unauthorized people into the units as well. Because Bruce, you're absolutely right. This has been exploding over the last 5 years, really bad over the last 2 years. And what they're predicting for the next 2 years in AI is going to be earth shattering. It was anticipated, but it was not anticipated to occur as rapidly. I mean, Elon Musk anticipated it and told Congress and told the world that. But this AI is going to be a major influence, and it's not good, in my opinion, for residential landlords. It's going to be a major influence on how you guys rent, how landlords maintain the property, and all at the same time, speaking of maintaining the property, at the same time, the laws are getting tighter and stricter on habitability issues and what landlords are expected to maintain in their properties to meet these habitability requirements. So I don't pretend to have any answers to this. I can just tell you what's coming. Eviction, you're going to have more tenants in your apartment because they're not going to qualify by themselves. You're going to have harder times getting them out because there's going to be a lot of people who can't pay the rent. Look what LA tried to do just a couple of weeks ago. They tried to raise the minimum rent threshold so that you could not evict a tenant for non-payment of rent until they were 3 months behind in rent. So this is coming. It's coming rapidly. And I think anybody who intends to stay in the industry has to make a determination. You know, even the screening laws are changing now. They're tightening down on the screening laws. So it's very difficult for a landlord right now to say, no, I don't want you as an applicant. They've pushed it. It's not entirely in place, but they've pushed it now so that you virtually have to accept the first qualified applicant who walks through the door. So it's going to change the landscape of the application process, being a landlord, who can afford to be a landlord, what it's going to cost to get somebody out when they do lose their job to AI. It's cataclysmic as far as I'm concerned. And I know other people may not agree with that, but I just can't see how this is going to bode well for landlords.
So many
Let's say that you get to use that word cataclysmic for real 2 or 3 years from now. What do you think interest rates will be to refi your apartments?
That's a Gil question. I don't really know.
Yeah, it is, Gil. You know, I mean, if you have huge unemployment, do you think we're going to have interest rates go back to where they were?
Well, we've had a very strong foundation. Our market hasn't been able to break 3.8 or 3.6 in the last 3 years.
But Bruce is asking if we have a COVID-like event on employment, because unemployment was 15%. You have something
that lasts for 3 years, not 9 months.
Yeah, exactly. So do you think his question is, do you think the government takes the rates back to zero to save the economy, essentially?
The government doesn't change rates or control them. The U.S. Treasuries are an open auction. What creates demand is fear. I mean, that's really the reality. COVID, we had a global fear. Everybody bought U.S. Treasuries. The question is, will U.S. Treasuries be the go-to product to secure your fear in the future? That's questionable, especially now.
I just want to clarify, Gil, when you're saying the government doesn't change rates, when we hear that the Fed has lowered rates or raised rates, they're talking about short-term rates, overnight rates at which one bank lends money to another, charges interest for that. You're talking about are the long-term rates that apply to that an owner would seek to finance an apartment purchase or refinance.
Absolutely, not short-term, but long-term.
Can I throw? Oh, I'm sorry. Go ahead, Gil.
Yeah, and what no one's talking about, which is kind of shocking to me, is the fact that unemployment is looming, but inflation's not dropping. So nobody's talking about, the stagflation that I think is the reality of where we're headed.
Gil,
So,
I think you're right first. Go out a few years when you have unemployment that gets 15% plus, then I think that changes it.
Well, that changes from, obviously to depression potentially. So
well, that's why I think interest rates are going to go where they've never been.
I have one more thing I want to throw on top of that. And I haven't heard anybody bring this up yet, but I've seen it building steam in the financial markets. I am speculating here that as the tenants become less and less able to make their rent, you're going to see these assets, when it comes to financing them, you're going to see them tokenized. And the tokenization of these assets, and if you haven't heard of this, like Bruce, you just started hearing about AI, I would start looking up the tokenization of real estate assets, because what companies like BlackRock are talking about is, hey, we're going to tokenize everything, including real estate. And that's going to allow investors around the world to participate in buying a building in Los Angeles. and they can do it right from their phone. And I think it's going to shake up. I think it's cutting edge as far as real estate, how the financing is going to take place in the real estate world. But I don't hear anybody really in the real estate world talking about that yet. It's more of a financial world. And I'd like to get Gil's feedback on that if he's heard of anything.
Well, so here,
Well,
let's
I
do
have,
this.
and by all
One
means,
second. Sorry, Gil. Just because we have a lot to get to. So this is a deeper conversation I think we save for the luncheon, because each of us will have a time
Great point. Yeah.
we're digging way deep there, only because I want to get through a few more here before we have to wrap up. But to everyone's point, especially Mike, you share some things, the long-term end goal that, say, the local governments have had. So for each of you, many of these investors, at least that I deal with, and if you look at the main block of apartment investors, these are folks that are, say, baby boomers, late retirement years. They're sitting on a significant amount of income, and they're asking the big question, given what we've shared and other items: do I hold? Do I reposition? Do I grow? Because economies of scale, actually, so I need to grow on behalf of the kids. Or do I just exit? Do I just wrap it up, call it a day? For each of you, what factors should someone be evaluating as they make that decision personally? And maybe just share a couple points, each of you, please.
I'm in that conversation every day. My average investor is in their mid 70s. They're looking at a portfolio that they've built either by accident or on purpose for the last 20 or 30 years. Their stewardship mentality has had them pay down most of their debt. This is kind of on average, right? There's lots of edge cases. And their question is, what do we do next? Most of these folks have not inherited anything from their families. They've made it themselves, and their kids are not in the business, quote unquote. They're not the ones that are the property management team. They're, doctors, attorneys, something else, maybe somewhere else, and not in Southern California anymore. And their exit options, they're kind of pioneering those for the first time. And there's a few things that they have on the table. One is to go to Gil and refinance and hold the asset through a potential stepped up basis event, right? Until that investor passes away, when the plan is stated, let's just sell all the assets at that point. Right now, there's no capital gains liability. Another option is to reposition into a different asset class locally where they can keep their hands on it. But it offers different economic volatility. Bruce was talking about what happens when labor goes, when it changes, and what's going to happen with interest rates. Challenging environments have happened in the past where it's a fully occupied building with non-paying tenants or with concessions that are being paid. And that's a challenge for the private sector landlord. And so they're looking at things like, a Dollar General or a triple net lease locally, right? Or then they're thinking maybe there's better locations with different political or economic factors that can protect me. And now they're even expanding their scope further. And then the Delaware Statutory Trust allows their smaller retail investor to do that at scale at a significant institutional level. And our office is really charged with thinking with them and on their behalf, based on everything that's being said, right? Like, what are the attorneys in Savannah, Georgia, right, talking about with their tenants and landlords? What is the economist thinking is going to happen in Indianapolis with the industrial buildings? Those are all conversations that we need to be a part of. And most of our guidance is helping investors who want to exit strategically on behalf of their children, put them on a path toward their kids getting cash and not assets. And that may not happen immediately, but it's a tax deferred path ultimately through taking care of the next generation with a legacy plan and an estate plan that avoids capital gains tax, but also avoids the pain that they're feeling currently in the economy as they reposition.
Greg, obviously you have a lot of these conversations in kitchens and living rooms and Zoom calls every day here. What are one or two things you think someone should consider when they're asking that question: hold, expand, or exit completely?
I think it's a lot about kind of, John was mentioning, what kind of where they're at in their investment cycle, number one. Obviously we've got, younger investors that are looking to build their portfolio. And then we have investors who are nearing their kind of investment cycle and they're looking to kind of position their assets for estate planning purposes. And then, I have conversations, quite frankly, with clients who, I had one last week with a client that owns, a property in Manhattan Beach. He 1031'd into it. There's still a significant amount of gain in it. And even though that asset from when he exchanged into it actually is not worth what he initially paid for it, but he doesn't have any heirs. So he is going to, he was asking me about what my thoughts were on, doing seller financing, and then carrying back a note, which I think for some clients makes sense. And I think for him in particular, it did make sense. And so he had a fairly attractive offer with, like a 7-year interest-only note. And I thought that made more sense for him. So I think there's lots of, options for clients to have. I think sometimes clients kind of put on the blinders because they've owned this asset, their real estate asset, whether it be, units for a long period of time. They know the property and they're just kind of locked into operating that property. And they really have not kind of opened their world up to see, what are also some alternatives to that investment, whether it be a 1031 exchange, seller carryback financing, going into passive investments, geographic reasons. There's just so many opportunities out there that they could open themselves up to. They just need to kind of have that conversation.
Steve Spear, what are your thoughts?
I think each of you have said the correct thing. This is a question of an individual appetite. What is your appetite to work hard and do it right? Or what is your appetite to stop working and retire? What is your appetite to pay attention and make sure that if you're doing it right? What is your appetite for saying, I don't want this. I want something where I don't have to think about it. And this is a very individual decision. As Greg said, you have some young people who are trying to build their portfolio. You have some older people who would like to have time to walk through the park and eat a candy bar. And this is a question of individual appetites. This is not one size fits all. There are some people who should not be in this business, but then again, there are some people who should do or not do a lot of things. Know who you are, know what you want, know what you're willing to do to get what you want, whether that's more money or freedom, and then do that.
Mike?
I think it's a combination of what everybody said. Steven's exactly right. You got to know who you are. First of all, where are you in the investment spectrum? What's your end game? And you have to be real with yourself and honest with yourself and your family and sit down and say, okay, what's our end game? Are we really cut out for this? Is this, this is getting harder and harder and harder. AI is coming in. Look long-term. Even if long-term right now is just 5 years, right? Look long-term and ask yourself, what are we hoping to get out in 5 years? What do we anticipate the challenges being? And do we have that wherewithal to get through with it? And do we want to get through that? You got to kind of step back and be honest with the bigger picture and honest with your own investment appetite, like Steven said.
Gil?
I think what Bruce said is very powerful, that you have to look at your tenant mix first and see if, your tenants are in the labor department, or are they in the tech world? And I think the tech world is going to be hurting in the future. And I think that's more middle class America, maybe even owners that are going to become renters. So I see the labor market being the strongest market for your tenants. The CD markets are going to continue to be strong, and you're going to see middle America moving into C and D buildings. So I think there's going to be demand there. I think if they're positioned correctly, they have the equity position, the liquidity to substantiate issues in the future, I think they can be in a good position.
Now, Bruce, you have a special vantage point on this topic because you sold all your assets, to the best of my knowledge, in California. You went to Florida before Florida was sexy. Now everyone says, oh yeah, go to Florida. It's a good idea to invest in Florida. You did that years before most people understood the power of what Florida held. What should investors be, again, considering as they're trying to ponder, hey, do I stay in this real estate at all? Do I expand on behalf of the family? I call it the financial legacy. Do I exit? How do I know if I'm still cut out for the new regulations? And how would you say one goes through that process?
I guess I'll just talk about what I decided We had a panel one time. We had hundreds of people that were clients of ours. We had panel from that were the legislatures that made the laws of California. So they were on a panel and we got to ask them questions. And after that day, I decided I wouldn't own anything in California because it was so lopsided. And I also bought houses. Sometimes they were occupied. Occasionally, it took me a year to get them out, and they weren't supposed to be there in the first place and cost me 50 grand. So, that was the beginning of me thinking, okay, I'd like to go to a state where the ownership is honored more than the tenant's rights. And that was my decision process. Um, my use of charts allowed me to steal lots. I'll just tell you the story really quickly. I was going to interview Doug Duncan, chief economist of Fannie Mae in 2015. And to prepare for that, I read the quarterly financial report for Fannie Mae. And in it, it said that 25% of Fannie Mae's losses came from Florida. And I thought, how could that be? And then I went to look at Florida, and had a 4-year foreclosure process. They were still in 2011. And so the first thing I did was call a friend of mine. I said, let's buy a tract of lots because no builder can build at the cost of an REO. And so we bought a tract of lots and I built my rentals.
If someone watching this owns apartments today, and if each of you could share, what's the one strategic move they should at least be thinking about in the next 12 to 24 months from your vantage point? What's the one strategic move that they should be thinking about? And whoever thinks they have it.
Oh, I think the one strategic move they should be making, I'm being very serious, is they should be setting appointments with the gentleman on this call to sit down and develop their strategy. Figure out what you need to do for the next 5 years or 10 years, as far out as you can, and get a game plan in place because things are changing rapidly.
Figuring out who you are and what you want in life is always difficult for two reasons. First, it's hard to tell at any given moment what that is. It's hard to determine. But the second thing is it's changing constantly. And I think one of the biggest pitfalls for people who own real estate for a long time is they think everything is the same. Well, it's later than you think. It's later than you think in your lives. It's later than you think in the economy. And the best way to do this, if you're going to be in any investments, you can't just put it in a bucket and have a faucet that you turn on and the money comes out. You've got to do it on purpose, do it carefully, do it intentionally. And the only time to do that is always, always, always right now.
I would say, I have 4 kids. 3 of them are, of an age where they're starting to, have professional jobs and going to look for apartments. And all of them, are not looking for, when I was a kid, I really didn't care where I lived when I was a young adult, but all of the kids now, they really, the places they want to rent, they want to see them, in pretty nice shape. So I would say, you talk about it a little bit in the seminars, doing those renovations, to improve the property, I think is, money well spent. And I say, if I was an owner and I owned units, that's where I would kind of focus my efforts is, one, making sure that I had either a property management company in place or I had, somebody, a trusted advisor that I could talk to about, making sure I didn't get in trouble from a property management standpoint. I get so many calls. I got a call yesterday from a client that was not a 1031 related question. It was a kind of a legal question that, wanted to read to me what GBT chat had, told them about this problem. And I was like, I don't even want to hear what you have to say or what it had to say. I'm like, so many times, I have had clients that have done this AI chat that have gotten bad answers. You really have to, it can't take the place of a legal professional. You have to go seek legal advice. So that it's very important that you have a good team in place. Mike mentioned it earlier, to support you. And, I know Chris, have done a fair amount of renovations on your properties. I know that, a lot of the owners out there look at it a tremendous value in increasing the value of their properties. And so I would say, that's where I would focus my efforts today.
Gil, any thoughts?
I think now more than ever, because of AI, because of all the turmoil that's happening and volatility in the market, people need to have and know what their, let's call it, their zone is. What are their capacities? If they lose 10% of vacancy, are they in trouble? 15%, 20. What are the capacities? And then they need to think out loud. If these capacities are restrained, what do I do? Do I have the capital infusion to sustain them, or do I need to sell? Do I need to refinance one? What I've been talking to my clients about is having cash on hand. And a lot of multifamily investors, for whatever reason, never do. They're very non-liquid. I've been seeing that for years. I think there needs to be an ability to have liquidity. And in some cases, I'll see some properties that have maybe smaller loans, and I'll say, why don't we get a refi and pay those off completely? Have yourself a little safety plan. Give yourself some cushion. More than ever now, you need a game plan and cushion.
John?
Yeah, I agree with Gil on the game plan piece. There's two things that I'll oftentimes clients will call me asking questions about what is a Delaware statutory trust. It's a thing that they've heard about and they want more information on. But where the conversation typically goes is in two places. One, I help them understand what they currently own. So one strategic thing I think that your audience can do is sit down with you, Chris, or with me, or a professional in their world who can help them look at their assets like a financial asset. Right? What is the cap rate? What is the cash on cash? As Gil said, are you taking money into reserves? Are you planning for insurance increases? Are you planning for vacancy? As my investors age, income becomes more important than the asset value. And when their income drops, those who depend on the income are in trouble. And that's where you see distressed sellers. And we don't want to see our senior community in this distressed seller scenario. Those who've typically, they shouldn't have to be there with proper planning. The second strategic thing that I would advise is that the patriarch investor or the first generation investor have a conversation with their children about what is the long-term plan here. Do you want these assets to be a part of our family beyond my lifetime? Or do you want these assets to be a springboard for you to build something else? And if that's the case, it really drastically changes. There's this pivot that happens at some point along the line, which when investors go from accumulation mode to management mode to then legacy transition thought. And I think there's a woeful lack of intentionality on behalf of all of the professionals kind of that are speaking into the lives of these investors on what their options are entirely. And what I've seen happen a lot is that unintentional transition happens and that next generation just fights like cats and dogs to figure out what to do next. So I think my heart is in peaceful transition with families. And I think that conversation needs to happen more often in and around the dining room table in these families.
And Bruce, one strategic move that investors should be taking advantage of the next 12, 24 months.
I guess I would land on the conservative square as well. I would have a lot of cushion because we could be up against some things we haven't seen before. And I'm real big on no debt and cushion. So and I'm very grateful to have landed there because there were plenty of days where I didn't have that.
You know what's funny, Bruce? You just said that. I remembered in the early days of COVID, I called Bruce because I looked to him as all of you as one of my mentors. I said, Bruce, because who knows? We thought no tenants were going to pay rent. We thought a lot of weird things. You take yourself back then. Now it seems like that's a silly notion. But I had clients saying, Chris, if nobody pays, what do we do? And these sorts of things. And I called Bruce. I said, Bruce, what should I do? And the first thing he says, Chris, how much cash do you have and can you pay down all your debt? And it's funny. So you did recommend that at that point to just be as little debt, as little leveraged as possible. So
when you
yeah,
get on the airplane and the flight attendant explains to you that your seat bottom is a flotation device and you'll use it in the unlikely event of a water landing, most of you have never landed in the water on an airplane, but you know about it and you're as prepared as you can be for it. That's exactly what we're talking about here. You want to know where the fire exits are in a theater. You want to know that you're what to do in the event of an emergency. And then you do your best to avoid that emergency. But when it happens, if it happens, you're more ready for it, more likely to survive it, more likely to turn out okay.
And with that, I want to thank each of our panelists for taking the time to share their perspective today. What you heard this morning is really a reflection of something many apartment owners are already sensing. The environment around this asset class is evolving. The legal framework continues to change. The financing environment has shifted. Operating costs are different than they were a few years ago. And at the same time, broader economic forces are beginning to influence how investors think about the next phase of the market. None of that means apartment ownership, as Steve said earlier, is no longer a viable investment. But it does mean that the decisions owners make today require a little more thought, a little more strategy, and a clear understanding of where the risk and opportunities actually are. And that's really the purpose behind conversations like this. For those of you who joined us today because you've heard about our Apartment Owners Educational Luncheon, this webinar gives you a small glimpse into the type of discussions we host at that event. At the live luncheon, we we dive deeper into many of the topics that you heard today, whether that's legal exposure, financing strategies, tax considerations, or the broader economic outlook for multifamily housing. It also gives owners an opportunity to sit in the same room with professionals like the panel you heard from today and ask questions that relate directly to their own properties and their own situation. For those of you who live outside of my immediate service area, I'm glad you're able to join us today. We get many complaints of Chris, why don't you open up the geographic coverage more broad? I always say, why doesn't your broker host an event like this? But we can only seat so many, and it's reserved for the areas, of course, that we service our personal clients and so forth. So I wanted to offer this for you to be able to participate, and again, get answers from the same professionals that I seek guidance from every day. And for those of you who are local and who own multifamily properties in my team service area, if you found today's discussion helpful, insightful, and you'd like to join us at the event, we gladly would welcome you. And to see if you qualify for an invitation, I would say send us an email. You can email my team, the word email, at theapartmentdealer.com. Again, email at theapartmentdealer.com. We'll see if you qualify for a seat in the room. There'll be a few hundred multifamily investors like you that are joining us. Of course, our panel that spoke here today are the individuals who are going to speak at the event coming up at the end of this month. And again, I want to thank our panelists, Mike Brennan, Stephen Spear, Gil Figueroa, Greg Burns, John Taylor, and Bruce Norris for sharing their insight with us today. I'm sure the landlords are more than grateful. And I want to thank all of you for taking the time out of your morning to be a part of our event here. And until next time, this is Chris German from the Apartment Dealer wishing you positive cash flow, tenants who behave, and a financial legacy you can be proud of. Till next time.
Thank you, guys.
Thank you.
Thank you
Thanks,
all.
Chris.
All right. See you in a couple weeks.